Hej och välkomna till den här videon. Idag har jag med mig vår förvaltare av BMC International, ex-USA, Chris, som precis har varit i Japan och träffat massvis med bolag, befintliga och potentiella innehav. Och han kommer berätta lite om sina tankar om från den här resan och mötena med alla bolag. Så jag gör så här, Chris, jag lämnar över till dig så kan du ta oss igenom dina tankar och summera den här resan för oss.
Hi, Christopher. So I'm going to take this meeting in English. And yeah, I've just recently come back from Japan, where, as Christopher mentioned, we met roughly about 35 companies, both holdings that we have now and potential holdings. And we met all of these companies at their headquarters, spoke to their CFO, and that's a huge part of our process in terms of kind of going through understanding the companies ourselves, doing all of our own research, and really kind of getting out and actually sort of understanding what's happening with the companies on their home turf at their headquarters, which meant a lot of taxis, which meant a lot of time going around Tokyo. But it was really helpful in terms of the information that we got back from companies. So that meant that basically we were doing roughly about 6 meetings a day, which was really helpful. And I guess kind of the key feedback that pretty much we would get from all of the companies was as similar to kind of what we talked about in the past regarding market reform. So for those who are unfamiliar, Japan's kind of going through this large market change at the moment where they in the past had probably too much unprofitable business and they weren't very efficient at using their assets, and they had kind of assets on their balance sheet that they weren't using and too much cash and things like that. They had very good products and they'd often be, the revenue growth would be very good, but they just often weren't sort of particularly efficient with that. So they might have loss-making business, they might have low return on invested capital business and things like this. So effectively what's been happening is there's been this large market reform recently, which has meant that a lot of these kind of efficiency gains have been coming in. So that was a lot of what we would spend time talking about. And there was actually, I think what we sort of really like is this kind of the vrid moment you kind of get from a lot of these kind of changes. So for example, a number of companies that I would be speaking to, they would actually have loss-making business where they would genuinely be losing money for every sale of whatever they were doing. They're now all looking to exit that. So you get a situation where profit mechanically improves just from the fact that they sort of stop these kind of crazy loss-making projects that they have. So that was kind of a lot of the feedback that we would really get, was that culturally there's been a big change, like a really big change. And everyone really understands now that they actually need to kind of be running as efficiently as possible. They need to be generating as much margin as possible. They need to have a much more efficient balance sheet, and they really need to sort of be much more rewarding to shareholders, and they can't just sort of sit on cash and sort of do nothing. So pretty much every single company that we spoke to is coming out with what's called a medium-term plan, where they talk about the next 3 or 5 years and they say, you know, what their sort of goals are. And what you always find with all of these companies is they say basically, okay, here's what our margin target is, here's how we're going to get there, and here's how we're going to run our company much more efficiently. And almost always that requires a massive step up in terms of profitability and a massive step up in terms of buybacks and dividends. And what we sort of really like about that is that these are quite easy wins. So a lot of the time it's actually just kind of running the business more and smartly, more intelligently. So again, removing that loss-making business, for example, if you have a huge amount of cash on your balance sheet, just pay that out to shareholders, do a large buyback, and, you know, obviously kind of give that back to shareholders. And once they do that, they've sort of noticed that the returns on the back of that have been extremely good. So they think, okay, well, you know, this is actually something maybe we should do more of. So we were really positive to see that. At the start, they were maybe a little bit uncertain. Now they're very much leaning into that. You know, how can we do more of this? You know, they're sort of starting to go through and look maybe factory by factory at each product and say, okay, well, this is not a high enough margin. We're going to exit this product and we're going to focus on this very profitable one so that the overall group is much more profitable and will pay that capital out to shareholders. So we were really excited to really see this kind of trend accelerate. And what you always notice is that as a company starts to focus more on these kind of trends, the price will almost always kind of re-rate at the same time. So one of our holdings, for example, Asbill, it's got about an 85% market share in HVAC control mechanisms for factories. They came out with a 6% buyback, which was one of their first ones. They had too much cash. They wanted to improve their return on equity. They came out with a large buyback. The price jumped 10% on the day and has continued to move up. So these are the sort of trends that we like to kind of see, and obviously kind of companies are getting more and more aggressive with them, which is obviously sort of meaning, better and better results for us as shareholders, which we think is fantastic. So if we just move on, we can kind of see some of the holdings that we met there, and obviously as we talked about meeting the management teams, and in particular the CFOs or the CEO as a really important part about it. And I think what we really kind of like about it is that a lot of the time, the Japanese are very, very conservative with how they kind of maybe message the market. So they'll say, okay, we're going to put out a medium-term plan. It's going to be very achievable, because it's not a good look if you don't achieve those targets. So what we find really helpful is that when you actually meet management, oftentimes they say, here's what we've sort of said publicly to the market, which we think is very achievable, but here's what we're actually sort of aiming for, and this is what we think is kind of a reasonable target to achieve. And for all of these three companies here, for example, almost all of them are dramatically improving their shareholder returns. So Kandenko did a large buyback last year. Open House is returning a huge amount of capital to shareholders, while also they build houses around Tokyo. The Tokyo housing market has been white hot on fire, so that's been doing super, super well. But they're returning a huge amount of capital to shareholders. And Coca-Cola Bottlers Japan, they, as you'd imagine, sell Coke. But they're focusing much, much more on improving their margins and, again, returning capital to shareholders. So large buybacks, really trying to focus on running their business kind of more efficiently, which we really, really like as well. So if we just move on to sort of what's next for Japan. So as we always sort of said, these rules that got brought in Japan, that was sort of a first step. So they had to start small and then get bigger and bigger and bigger. So what we've found is that there's actually sort of new rules coming on from Tokyo Börsen and Finansinspektionen in Japan. So they're saying, okay, those first rules worked pretty well, and now companies are putting those in place, which we think is good. But very much there's more to do. There's a lot more to do. And we've always said that this will be a sort of a 10, 20-year process, basically. And Japanese companies still hold an enormous amount of cross shareholdings or cash or assets that they shouldn't really be owning anymore. So really what's been happening is there's been new rules coming to address that. So now there's actually a rule coming out which has been kind of put in. You can kind of read about it down the bottom there, which says if a company has excess cash on the balance sheet, which Japanese companies have over 100 trillion yen of, so Japanese companies have enormous amounts of assets on the balance sheet, you must now pay that out to shareholders. So you can't just sit there with cash and do nothing with it. Inflation has been, for the first time in a long time in Japan, is becoming an issue. And obviously inflation, reduces the value of that cash. So you need to pay that cash out. We want to see this coming back to shareholders, whether it be dividends, whether it be buybacks, whether it be sort of investments in kind of growing the business and making sure that you kind of grow the profits for shareholders. So this rule is going to be a really important rule over the next sort of, say, 5 years. And buybacks and shareholder returns are already at all-time highs in Japan, but this is really just pouring more fuel on the fire. So it's very, very common that you'll often see Japanese companies start with a small buyback and then come out with very aggressive buybacks. So I mentioned Asbill before. They came out with a 6% of total shares buyback. They're gonna do that probably in the next 6 months. For example, Kyocera, which we'll talk about in a minute, they want to buy back 70% of the whole market cap of the company. So we kind of see these whole kind of trends as really starting to accelerate, and especially with these new rules. So what we think will be kind of the next rule to come from Finansinspektionen and Tokyo Börsen will be a focus on margins. So Japanese companies are already doing a pretty good job of kind of focusing on margins, but the target's quite low. So they might say you need to kind of earn what's called your cost of capital. So it might be like a return on equity of, say, 7%. American companies often run with a return on equity of 20. There's absolutely no reason why those Japanese companies can't be doing what the Americans are doing. So we think that over time, that those return on equities will be sort of pushed up from, say, 7 to 10 to 15 to 20 over time. So we think kind of the ability for them to try and improve profitability and also sort of improve efficiency is huge. And a lot of that will sort of come down to large buybacks and obviously sort of, really good returns for shareholders, which we're really positive about. Moving forward, we're just going to talk a bit about a case called Kandenko. You might have heard us talk about this before. We met the CFO in Tokyo, had a really good chat to him. We've met him multiple times before as kind of part of our process. For those who don't know Kandenko, so they work as what's called an electrical contractor. So they do sort of four main areas. So they actually used to be part of what's called TEPCO, which is basically the large power company around the Tokyo area. So a lot of what they do might be doing installing electric power lines, for example. So that's the info and comms business. They also help actually go and renovate buildings, for example. So any electrical wiring within the building, they'll go and renovate that and take that out. And Japan's going through a phase where a lot of buildings are very old now. So they were built maybe in the 1990s and they need to be renovated now. So Kandenko will do that work, as well as also actually sort of building, data centers, semiconductor factories, which Japan is having an enormous expansion of that right now as well. So this is a really high quality business. And what we really like about it as well is the fact that, like many Japanese companies, it hadn't had a lot of price increases for, say, 30 years. It had sort of okay margin. It was actually a good business, but it was sort of having an issue with inflation for the last 30 years. And we'll sort of talk about what changed there. What's also interesting as well is that, like many Japanese companies, they had what's called cross shareholdings, where they own shares of other companies. And they actually had a bunch of hidden property on the balance sheet. So the way that accounting works is that when you buy property, you keep it on your balance sheet at the price you paid for it. So if you have property on your balance sheet from 100 years ago, it's in there at the price of, 1926. So all of that inflation, and which has actually sort of pushed the price of that property up, doesn't get shown. So what we actually found as well was that Kandenko had roughly about 65 billion yen of apartment buildings just sitting on their balance sheet that they didn't really need to own actually at all. That sometimes hard to understand how much that is. That's 300 million euro of apartment buildings that they just didn't really need to own anymore. What we found was that through this kind of reform process, if you hop over to the next slide, you can kind of see it here. So the way that it works in Japan was that basically the government banned overtime hours. So many people were working a long time and they would say, okay, if I can't get a price increase, I'll just work more hours to try and get more money to try and survive. The government actually banned that. And they said, this whole kind of idea about never getting a price increase is wrong. The box down the bottom, you can actually see there, they now have a government bureau or kind of group which basically goes through and makes sure that Japanese companies are putting through price increases. So they want to see you putting through price increases. They want to make sure that people aren't just working too much. And what that means basically is that they're actually asking someone like Kandenko to have a higher margin and make more money, become more profitable. They're basically selling hours of installation, and they want to make those hours of installation much, much, much more profitable. And if you hop over to the next slide, you can kind of see that. So in about 2023, this is kind of where they started with this kind of profitability improvement. And over the course of this time, they put through much more price increases, which dramatically improved the EBIT of the company itself. So they were in a situation where they might have been earning, say, 6% margin. It's now up to a point of being, roughly about sort of 10 to 12. And they think that they should be able to kind of get that to 15 in time. So a situation where you'll be nearly kind of tripling your profitability while also growing from, building new data centers, building new semiconductor factories, etc. as well. The thing on that we like about it as well is that we talked about those cross shareholdings, we talked about those apartment buildings. Those are what's called non-core assets, or assets that you shouldn't really be owning. If you want to own property, go and buy maybe a REIT or a property company or something like that. You shouldn't have to go buy this company which also owns property. That doesn't make sense. So what happens is that they've been selling those assets and they've been paying those shares back to that value back to us via buybacks as well. So we get significantly improving profit while also a much more sort of shareholder friendly return profile from the dividends and the buybacks. And on the final slide, you can kind of see what that's meant. So when we first started looking at Kandenko, you could pretty clearly see that they were going through a margin improvement program. What was interesting was that because of the nature of sort of Japanese management and Japanese analysts and things like that, they're very conservative. So they say, yeah, well, we're doing this, but We're not necessarily sure how much this will improve things by, but we'll just sort of we'll start low, and then hopefully we can do better than that. And this is a representation of what happened last year. So share price started at roughly about 2,500 yen. They go through absolutely smashed guidance. So they came out and they said, okay, our original forecast was 37 billion. They then raised it to 58. They then raised it up to 63, and then they raised it up to 80. And then they actually ended up hitting at 83 billion. So they started at 37 and they actually came through at 83 billion. So, well over double what they originally thought, just from the sort of the impact of these kind of price increases as well. So it was really nice for us because obviously the share price went from, say, 2,500 to nearly sort of 7,000. So, as that kind of thesis plays out, obviously the market realizes that and realizes that this is a structurally higher, more profitable business as well. Moving on to our next case. So this is a slightly different case. Japan is a slightly interesting market where it has a number of what we call conglomerates. So companies which maybe have 50 underlying companies or dotterbolags. So Kyocera is one of these companies. They would describe themselves as being in the electronic industry. So whether they make semiconductor packaging, whether or not they actually do 5G towers, whether or not they do a huge amount of kind of different products underneath that, whether it be battery packs or sort of what's called slips for battery packs. It's a very, very, very diversified business. One thing which was really interesting when you first looked at Kyocera was that if you look at their market cap was roughly about, say, 2.4 trillion yen. For that 2.4 trillion yen, you actually got 1.6 trillion yen of KDDI shares. Now, what is KDDI? KDDI is just Telia. So if you were buying one share of Kyocera, you basically got about 70% of that share owning some KDDI. So they had a huge amount of cross shareholdings in this kind of stake of this company KDDI, which they actually originally started. So their balance sheet wasn't efficient at all. So they had all these different businesses which weren't really that profitable, plus they had an enormous amount of assets sitting on the balance sheet. Now, what was really interesting was basically they said, okay, we're not actually, or one of the rules of the actual underlying market reform is that you can't have these cross shareholdings anymore, or you can't have much of them anymore. So that meant that basically Kyocera had to sell down an enormous amount of their market cap in KDDI to get that down. So that means that this sort of 1.65 trillion stake in KDDI, that has to turn to cash. So they'll sell that and then use that to buy back shares. So the math basically being, okay, if the market cap is 2.3 trillion, we're going to get 1.65 trillion back in cash from just selling our KDDI, because now we need to sell this. This is one of the rules of the reform. We need to get rid of this. So that's exactly what they've been doing. So last year, Kyocera sold down 250 billion of KDDI. Then they used all of that to do a buyback. That was roughly about 11% of the market cap. They did the exact same this year. There's actually a chance that they might do 350 billion, so start to actually accelerate that sell down a little bit. As a reminder, they've got 1.65 trillion in KDDI. So we're not even really 1/3 of the way through the sell down yet. And all of this money is used for buybacks. So you'll be in a situation basically where they'll basically be buying back 70% of the entire market cap while they sell their KDDI stake. So an enormous amount of kind of value returned to shareholders, and it's absolutely incredible. Moving on, you can kind of see roughly what happens with this business as well. So when you're an analyst, you sort of see the average, right? So you see the profit that the whole group reports. But what's actually making up that total amount of profit is that they've got some very profitable businesses, and they've actually got a huge amount of loss-making business in there as well. So many people don't realize this, but if you look at this 2.5 trillion yen of sales, they've actually got roughly about 1 trillion yen of that, which doesn't make any money and is roughly break even. The interesting part about that is that's actually in a really interesting sort of semiconductor packaging business, which is actually on fire right now and doing really, really, really well. So what was interesting as well is on top of that, they actually had loss-making business. So they said, okay, we were doing roughly about 2 trillion yen of sales at about a 9% margin. We want to get to 2.5 trillion yen of sales and at a 14% margin. But to do that, what they were actually going to do was exit a huge amount of this loss-making business. So the profit would go up purely just from basically focusing more on actually sort of profitable business. And that's exactly what they've done. So they've sold a number of kind of assets which weren't actually making any money. They were wasting a large amount of R&D money and capital expenditure on factories which weren't generating them any free cash flow. They stopped all that, which is good. And more importantly, they actually sort of showed the market that a number of the businesses that they do have are really high quality. Many people used to think that Kyocera was kind of a low margin, not very high quality company. That was because of the fact that a lot of their good quality revenue and good quality margin was hidden by bad quality or loss-making margin. As you sort of strip away that loss-making margin, you can actually realize that the underlying Kyocera group is actually far more profitable than most people think. So this is what we like about it, is that it's actually quite a simple investment thesis. Just stop losing money. You know, if it's not making any money, get rid of it, sell it to someone, turn that into cash, give that cash back to shareholders, and then focus on your good profitable businesses, which they actually have a lot of as well, which is really impressive. So we think that these numbers that they've put out here, 14% profit ratio, is actually still very low. So they think by the end of the decade, their return on equity, they can get up to about 10%. They're targeting 7 here. So, we're still only kind of maybe step 1, step 2, step 3 of the way through this process. And there's still a huge amount more of this kind of improvement to go. And the fantastic thing about it is that the market loves them doing this. The market really did not like when they were kind of a conglomerate where they only sort of, didn't really focus much on profitability and had all these assets on their balance sheet. As they go through the simplification process, it's been incredibly powerful for returns. So you can kind of see when they first announced this plan, actually, they could see it on the day. So they announced it roughly in July last year, and they said, okay, we're going to focus much more on profitability and efficiency now. That's exactly what they did. The chart is actually slightly old. The price is actually now at nearly 3,300 yen. So it's basically been 100% return in less than a year, just from actually just focusing on, purely just actually making more money and being far, far, far more efficient. And what we really like about this is that there's a huge number of these cases in Japan. So I've got a list of, 35 companies that I've got to go through the notes of and try and pick a number of these out. And what you'll always find is there's a huge amount of cash on the balance sheet that needs to come back to shareholders. The companies are always having far too low a margin. And then basically the companies are always kind of thinking about, when are we going to actually start to kind of follow a similar process to Kyocera? So that's a lot of what our conversations are that we have with management. How are you thinking about cash? How are you thinking about margins? How are you thinking about buybacks? And, what's the sort of the timing on those sorts of things? And, when can we expect you to do that? And almost every single time the answer is coming back of, we're thinking about doing something about that soon. And we want to try and be as aggressive as possible to try and comply with the rules. So we really think that the next sort of 5 years to 10 years in Japan is going to be an extremely strong time for returns. And Japan's been one of the best markets for returns this year and last year and the year before because of these reforms. And we really think that trend will continue. And that's why with BMC International, we have nearly 40% of the fund in this, following this kind of improvement trend, because we really sort of see that these kind of Japanese companies are super shareholder focused and the possibility for returns are absolutely excellent. So I'll pass back to Christopher, really appreciate you dialing in.
Tack Chris. Du pratar mycket om Japan och som du var inne på så har vi en fond som heter BMC International som startade här i slutet av november 2025. Där har vi exponering som varit inne på mycket Japan. Vi har en stor exponering mot Polen. Vi har en stor exponering mot andra typer av regioner där vi tycker att vi ser väldigt intressant tillväxt. Det finns lite olika tillväxtdrivare, lite olika drivare för marknaden, som Japan har sina marknadsreformer, Polen har landet som i sig växer, bolagen växer och så vidare. Så det är en superintressant fond och en fond som har ett lite annat fokus än en annan typisk global fond, eftersom vi då framförallt exkluderar de amerikanska bolagen. Så tittar vi på den exponeringen som vi har per den sista april, så ser vi att cirka 30% av den fonden var i Japan, cirka 9% var i polska bolag och vi har Sverige, holländska bolag, Frankrike och så vidare och så vidare. Så det är en superintressant fond som ni kan titta lite närmare på. Bra, men då tackar jag dig Chris för att du tog dig tid och kopplade upp det här och pratade lite om den japanska på resan och alla de spännande japanska bolagen och den japanska marknaden. Och så får vi köra en ny sån här inspelning kanske när vi har varit i Polen nästa gång. Så går vi igenom den polska marknaden.
Tack.
Tack. Ha det fint. Hej.